Today, we're going to be sharing with you the top 3 options trading strategies for small accounts. Now, if you have a small account or a big account, these should be able to work in any size account. Now, of course, I should take that back. You shouldn't say should when it comes to trading, but these strategies could potentially work, I'll put it that way, in any size account. So let's watch this together. The top 3 options trading strategies for small accounts.
It's entirely possible to start trading options with a small account. The purpose of this video is to share 3 of those strategies with you to give you a feel for how flexible options can be in terms of capital utilization. And in order to explain how these strategies work, we need to make sure that you understand how stock and index options work. Now, if you're new to options trading and don't know what stock and index options are or how they work exactly, we've created a video for you to understand options basics. And if you click the video appearing on your screen right now.
By the way, our RCP3 Kids says, wow, S&B Capital taking on the big dogs. Yeah. I mean, if you put a video out on the internet talking about options trading, you never know when some random guy on the internet's going to talk about it.
Now, it will lay out the groundwork for understanding the strategies we're going to be teaching you in this video. So when you're finished, you can come back and watch the rest of this video. The first strategy we'd like to share with you is what is known as the iron condor, and it's very easy to understand and implement.
Oh, frick no. Boy, I can't wait to go about this. This right there, these were my gateway drugs, the iron condors. Now, ooh, this is going to be a good video. I don't think that they actually trade these. Papalopoulos is saying, if you watch any of their interviews, they only go long or short. They don't do spreads. An iron condor is a spread. Let's talk about what an iron condor is. Ooh, baby. Iron condor. This is about to get real dirty around here. Go put your boots on. We're going to traipse through the mud with an iron condor. All right. So let's actually give one that has a appropriate risk return profile. Let's go, because some of these are not really showing the risk. And what I mean here is like this one right here. It's you when you earn 2 or you lose 3. It's more, and this one like is super wrong. That's more like you win 4 and lose 1. The opposite was true for me. It was a lose 4, earn 1. Give me one that's actually realistic here. Come on. Yeah, there we go. Look at how deep that is. Look at how deep that is. That'll work. Okay, let me do open image in new tab. This is what an iron condor looks like. So let me just draw all over this. Let's draw all over this. So this is the current price, and let's say, does it have down here? Stock price is 21,000 and change. We'll just use 100. Let's say that the stock price is 100. Okay, the stock can move up, the stock can move down, or the stock can go nowhere, and you will still profit. However, if you can see, and this is why I chose this one in particular, when you take a trade like this, there are some humongous losing areas, giant losing areas. So in this case, it looks like the max gain on here would be $75, and the max loss would be, oh, maybe not 75, maybe 66. It's kind of hard to tell. They don't have it mapped. Let's say it's 66. And then the max loss here is 134. Hang on, I did that wrong. 134. 134, which means this is a $2 wide spread, which means that if you lose double the possible amount that you could have ever made. Okay. So if you lose on one trade, now you need 2 perfect trades in a row, which is not so bad to get back to break even. For me, it would take 6, 8, 10, 12 trades in a row. Like that's what it was like. In fact, rather than do an iron condor, maybe it would be better if I did a short strangle, because this will this should have a better, yeah, here we go. Open image in new tab. Now the difference between here and here is that with an iron condor, you actually are buying far out of the money puts and far out of the money options. That way you do have a limit to the amount that you can lose here. But to this point right here, right, you can make a small dollar, but you can lose a big dollar, right? And again, for me, it was something not like this. It was more like make 100, lose 400. That's a $5 wide spread. Or make 200 and lose 800. That's a $10 wide spread. Now, what that means here is that every win that you have sounds great, but every loss you have, now you have 4 trades in a row that you have to get to break even. But also, you've heard other channels talking about, you know what? Don't hold it all the way to expiration. You want to take your profits early. So really, you only want to take it for $50 because that'll increase your win rate. That'll increase your win rate. Okay, cool. So now I've taken half of my potential max profit, but I still have 100% of my potential max loss, which means I now need 8 trades perfectly won in a row to make up for the 1 loss. Do we see how we got to the math here? Do we see how we got to the math here? Okay, let's back this up. Let's back up the truck here real quick. In fact, let's go back over to this one here, and I'll draw on it better. It sounds so great because it can move up, it can move down, or it can move nowhere, and you can still profit. But if it does move up, or if it does move down, then you can lose bigly. So again, imagine we took in $1 credit on the trade, and it was a $4 max loss either direction. Okay. Now, again, people will tell you on the internet, well, that's okay. Just take it off at 50% of the max win. So you can only win $50, but your max loss is still the $400 in this case, which is 8 times more than the max win you could take. Everybody got it? If you got it, type the number 50 in the chat. Type the number 50 in the chat, because that was how Chris traded. And that's how Chris had an 84% win rate and lost $200,000 doing exactly what they're talking about with one of the top 3 options trading strategies for small accounts.
And so let's give you an example of how this works. So almost everyone is familiar with SPY, which is the ETF that represents the S&P 500. And so on Monday of this past week, August 28th, the SPY opened at 442.24. And so let's say that we pulled up an options chain that expires that same day, August 28th, which means that the trade has no overnight risk.
The frick did he just say? 1 day iron condors? Okay, we can't watch this video. This is actually legitimately really bad information. Really, 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 really bad information. Because now, what do you mean, Chris? It's really bad information? Because if this, surely he's not saying, we'll continue on. Surely he's not saying do 1 day iron condors. I got to take a breath here, because it's not only exacerbated with the amount of risk, but it's accelerated. It's exacerbated risk that's accelerated because you get this that much faster. You can blow up your account 8 times faster by doing it today. How's that sound? Surely he's not saying this.
Because the options expire that day.
Oh, Magnum PI. Genius as he is. Doesn't the risk not end when you close the trade early? I'm really glad you mentioned this, because this right here is the insidious nature of selling options. What do you mean by that, Chris? That's a weird thing to say. Because let's say that we have, and in this example, let's say we have 14 days to expiration. Okay. And let's say that the price has moved up over here. So you're looking at that $400 loss straight in the face, right? But I got 14 days. I got 14 days. So listen, it's fine. I'm going to let it run. And surely within 14 days, it'll come right back into my profit zone, and it'll be great. Because it has 14 days. This right here is the insidious nature of selling options. Because it has 14 days to go, there's still hope. There's still a chance. So you're saying there's a chance. There is a chance. But when you're in a trade like that, let's go over here. Let's say you boxed in this trade as an iron condor. Let me turn off order blocks so it's a little bit easier to see. Show hide order blocks. There we go. And now let's box in the trade. Because imagine you did an iron condor and it looks something like this, right? It can go, and you did on this day, it can go down, it can go up, it can go sideways, but either way, it will end within 14 days. And let's say that it blows out through the top of this, but it's okay because I've got 14 days to expiration, right? It blew out through the top. I've got 14 days to expiration, so it's totally fine. It should definitely come back. What happens? You're already in a trend and it already blows through, and there's no chance that it's coming back. So, yes, you could take it off early, but can you? Because if you take it off early, then you've eliminated that 14-day window where it could come back. And if I do that, isn't there a chance where it could come back? But if I don't take it off, then I have a chance to still win. Okay. If I don't take it off, then I still have a chance to win. But if I do take it off, then I've eliminated this 14-day window completely. That right there, my friends, is why selling options is so insidious. So insidious. Because you have this hope and prayer that things will come back for you. But unfortunately, it won't. How to take a small account and turn it into a $0 account. Yeah. Yeah.
And so the trade will be fully resolved by, at the latest, the end of that same day. And so let's say that at the open, you went ahead and sold 10 of the 445 calls for 25 cents and 10 of the 441 puts for 43 cents. And at the same time, for protection, you went ahead and bought 10 of the 446 calls for 11 cents and 10 of the 440 puts for 27 cents. Well, when you do that, selling calls above the stock's price and selling puts below the stock's price, and surrounding the calls and puts that you've sold with long calls and puts farther away from the market, that entire combination is what options traders refer to as an iron condor. Now, the cash flow of this transaction works like this. And so, starting with the 10 calls we sold at 445, you can.
Um the idea of cash flow in trading is so flawed. Okay, you get a credit for selling the option. So therefore, you have more money in your account. That is not true. Robinhood actually glitched out. And what they would do is if you sold an option, this was years ago, they've since fixed it. If you sold an option, let's say you sold an option, it was $300. That $300 now goes into your account that you could trade with. Ooh, wait a minute. That's an infinite money glitch. Yeah, there are so many horror stories of people who are like, okay, sell an option, and then go buy another option, and then sell an option, and then go buy another option, and then sell an option, and then go buy another option because it's basically unlimited money. In my opinion, this is not to be regarded as cash flow. This is your potential total net earnings in the trade. You should never consider that cash flow. Never once. Now, in this case, it's a $3 credit and a $7 capital outlay. Meaning, if I'm not mistaken, and I could be, but that means that if you win this trade, your max you could win because you only get the credit received here is $3, which means the max you could lose here is $7, which means this is $10 wide basically. Oh, that's because they sold 10 of them. That's why. So we'll use the round numbers. Okay. They sold 10 of them. That's right. Which means that if you lose this trade, that's now 2.5x to get back to break even. Okay. 2.5 perfectly executed trades at the $300 level to get back the $700 you lost. But he's probably going to tell you not to. And granted, I could be wrong. Well, no, this is 0 day to 0 day expiration, right? You know what? That's fine. Just YOLO. It's going to work out. No matter what, it'll get through there.
See that we sold them for 25 cents. But remember, each options contract represents 100 shares of SPY. And so you multiply that by 100, and we sold 10 of them, resulting in total cash inflow of $250 for those calls. And using the same logic, we collected $430 for the puts we sold and paid $110 for the call protection and $270 for the put protection, resulting in an overall positive cash flow for the iron condor of $300, for which your broker would only require you to have $700 in your account because that's the worst case scenario loss on the trade.
Right. The broker requires you to put up $700 in margin because if things go wrong, that's your max loss. Okay. This is not cash flow. This is potential earnings when the trade is over. I hate that they've labeled it as cash flow.
So even if you had $1,000 in your account, you could afford to execute this trade. Now, moving to the end of the day, the SPY closed at 442.76. And so let's take a look at what that means for our trade, because Remember, every one of those options expires at the end of that day. And so we can assign a value to each one of them. And in this case, that's going to be really easy because they each expire worthless. Why? Well, let's think about it. You see, the short
Oh,
call.
Rick. I was nervous he was going to do that. Hey, we can't watch any more of this video. This is really, 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 really bad misinformation for trading. Listen, just follow this strategy and you're going to make 30% today, every day. I cannot watch this video anymore for you. Just follow this strategy and you'll make 30% a day and you can repeat this every day. And it's going to be so easy. Look, you're probably going to have an 84% win rate. You're definitely not going to lose hundreds of thousands of dollars trading this way. Definitely not. Look, it's going to be so easy. It's going to be so easy. Just do this every day and your account will go up like that. Please, for the love of all things good, don't do this. Don't sell iron condors, period, full stop. He's going to talk about debit spreads here. I'm going to tell you why real quick. Debit spreads are dumb. Debit spreads are super dumb. Imagine you want to go long a stock, okay? And let's say that you love SoFi bros. So you buy the $21 deep in the money 85 delta call. Cool. So for every dollar that SoFi goes up, your option contract will go up 85 cents. That's amazing. Now, over here on the right-hand side, you'll see 85 delta, okay? If you sell a call against it, that's what's called a debit spread. Now, you might want to do this because you're like, well, that costs too much out of my account. So I'm going to go from the 21 and I'll do a $5 wide spread. Cool. So sick, right? Now my total outlay is only $386. So instead of $645, my total outlay is $386. Oh man, that's so much better. That's like half. But your deltas are now 26. So your total net delta is 85 minus 58. 85 minus 58 comes to 27. So you took an 85 delta trade and you just basically took 2/3 of it off immediately. So now you have a 27 delta trade. So you might as well have just gone and bought the 27 delta call because you're going to have the same result. There is no sense in buying an out of the money call, and there is no sense in buying a debit spread. If you have a small account, that's fine. There's no shame in that. I had a small account at one point. You want to start with a small account. That way you can learn risk management and then transition that into a big account. But you want to stay on a deep in the money, valuable investment that you want to get more valuable, not basically taking that valuable investment and saying, you know what? I don't like it that much. It's only worth 27 deltas to me. Yeah, there's no sense in buying a debit spread. No sense at all. I don't see any reason why anybody would would need to have a debit spread, period, full stop. If you want to be long, go be long. Would do it with a deep in the money option. Third one, leap options. Now, leap options. What is a leap? A leap option is basically one that's got a long duration. And that can be long to different people, right? It could be 6 months. It could be 758 days, right? Whatever. Leap options, and lots of people look like they're trading leap options on SoFi. They do the same thing as a deep in the money long call does, except they cost significantly more. Wait, what? They cost significantly more because of the extrinsic value here. The extrinsic value being at $8.36 is quite a lot, in fact. 838 divided by 1335 gets you 62%. So 62% of this option will decline over time. Now, that's 758 days, so it's like 2 years out. So it's not going to decline all that much. However, if we go to the same 22 strike, 21 days out, rather than $8, we're going to have 22 strike. We're going to have 61 cents. 61 cents. The intrinsic value will be exactly the same because the intrinsic value is calculated between the current price and your strike price. That will not change. The only difference in the price of the option results in the extrinsic value. And it's going to decay either way. So I would much rather be on this side where I'm only paying 59 cents versus $8 And if it doesn't work within 21 days, that's fine. I'll just move on. And I mean, if you want to be a long-term shareholder, let's put it this way. All stocks are bad, but every once in a while they act right. SoFi is acting right here. It's beautiful. SoFi did not act right here. But Chris, that wasn't anything. This was a 54% pullback. This was a 54% pullback. So all stocks are bad because a 54% pullback, even on SoFi, can happen. All you got to do is use the trend template, the 10 over 20, price over 50. You can buy the 21 days. If it works, you can roll it out further in time. Or you can buy the leap option and get the same intrinsic value move because you're roughly the same delta. Well, actually, would you be the same delta? Now I'm thinking about it, I don't think you will. I think your delta is going to be very different. On the 22 strike, your delta 77 versus, it's not going to be that different. 83. Okay. Not too different, not too dissimilar. So you could get nearly the same move, but you have to pay so much more. And then when it's not working, you get out of the way. Your 10 going under the 20, price going under the 50. And then when it comes back up, price 10 over 20, price over 50, you can run it again. So if you want to be a long-term investor in any stock, be a long-term investor, but do it smartly, do it strategically, do it when the trend template is moving in your favor. Do it when the outlier buy signals, which are only 82 cents a day, are in your favor. You don't have to do it on the way down. You don't have to do it when it goes down 50%. You can follow those buy and sell signals and ride them as far as they'll take you when they come, and then get out of the way when they aren't working. So those are their 3 top options trading strategies. For me, I don't want to overcomplicate it. Deep in the money, long calls if you want to go long. Deep in the money, long calls if you want to go short. Try and spend as little on the extrinsic value as you can, because that will decay over time. And make sure that whatever strike you pick has lots of liquidity. Over here, there's not much liquidity. Over here, well done, tons of liquidity. That's where you want to be. And of course, it's going to cost more. It's going to cost more to go deep in the money. And that's because the intrinsic value is what we're trying to maximize is greater, because it's the difference between the price of the stock and the price of the strike price. And it will always be the same. The 22 strike on December 19th, as well as the 22 strike on June 18th, will have the exact same intrinsic value. The only thing that is different is the extrinsic value. Maximize intrinsic, minimize extrinsic. And then just let it run. And if it works, you get out of the way. It doesn't have to be overcomplicated. Not at all. So listen, I don't want to watch any more of that video. S&B Capital has lots of great information out there. But this is not one of those things. This is not one of those things. You don't want to ever break the golden rule of leverage, and a iron condor breaks the golden rule of leverage all day, every day, and twice on Sunday, because that's exactly how it's set up. You put yourself in a situation where you can lose more than you can make, and by a factor of 2, 6, 8, 12 times as much. EO Addict says, watching S&B videos helped him understand all the different terms. They leave so many details off the table with their plans, though. Only scratching the surface with these videos is trash advice. I didn't say it. The EO Addict said it. Goody Damien says, Chris, when starting with a small account, not trying to jump the gun here, but do you think it's possible for me to potentially earn $1 within 6 years? Oh, yeah, for sure. I think you could earn $1. I mean, I'm only earning 4, so what do I know? The rule of thumb. Now, I want the outliers in the chat to tell me their experiences. That's what I really want to know. The rule of thumb is in your first year, if you can avoid blowing up your account, you are better than 90% of traders. 90, 90, 90 is the rule of thumb. 90% of traders blow up 90% of their accounts in the first 90 days of trading. Year 2, if you can get to break even, then you are well better than 90%. You're probably in the 95 percentile. Year 3, you're looking to post your first profits. This sounds crazy. I know. I can't wait 3 years to post my first profits. I need Lambos by next Thursday. Don't you understand? I get it. But there's a lot that goes in the market. And you don't want somebody who's performing brain surgery on you to have just started medical school. This is the same in the market. This is the most sophisticated, smartest people in the world, all trying to do the same thing, which is have more money in their account today than yesterday. Year 4, that's when you're looking to actually make good money in the market. That's when. Now, lots of people who are outliers have actually done really well in their first year of trading. Now that's no income guarantee or anything like that, but it's because of the principles we teach, which is cutting your losses short and letting your winners run out of control, right? Position sizing correctly, and it's 82 cents a day. It's unbelievably inexpensive, and they go to Outlier University. Did somebody say Outlier University?
Are you ready? Let's go!
Respect is earned. Respect is never given.
So Outlier University is our program where we are teaching traders everything they could possibly need to know about trading. Now, other people will charge $12,000 for services like this, $12,000 a quarter for some people. We give away everything with no additional cost. It is free inside of Outlier, which is only 82 cents a day, and it will be free as a replay on YouTube forever. So no matter what, even if you don't have Outlier, you do have all the tools to be successful, and I will give you everything, holding nothing back. So if that sounds good to you, make sure you subscribe. And if you're ready to save time, make money, and start winning with less risk, click one of these two buttons and have a fantastic day.